United States, President Donald Trump announced a 30% levy on goods imported from the European Union and Mexico, which goes into effect on August 1st, unless new trade deals are struck by that date. Mexico's government complained that the ultimatum was unfair, while Ursula von der Leyen, the president of the European Commission, is threatening proportionate countermeasures as all sides hope to get a deal done. The EU collectively sells more to the United States than any single country. Stocks closed down on Friday as sentiment soured just after the S&P 500 posted a new record high in the previous session as the US threatened higher tariffs across the board. President of the European Commission von der Leyen also stated as part of its response to the US that it is actively diversifying trade partnerships as it announced a political agreement with Indonesia to advance a free trade agreement.
Yes, indeed, the United States have sent us a letter with measures that would come into effect unless there is a negotiated solution. So we will therefore also extend the suspension of our countermeasures till early August. And at the same time, we will continue to prepare further countermeasures so we are fully prepared. Very important in this is always the second and the third element. The second element is to diversify our trade relationships. So this big and important political agreement on a free trade agreement with Indonesia is today a huge milestone forward. So we have, as you know, a two-track approach. It's very important. We have always been very clear that we prefer a negotiated solution. This remains the case, and we will use the time that we have now till the 1st of August. And on the second track, since the very beginning, we have worked and now are ready to respond with countermeasures. We've prepared for this, and we can respond with countermeasures if necessary. So this two-track approach pays off because we are prepared.
Hello, this is Bode Oshosami, and welcome again to Global Business Insights, where we go into more depth on business headlines. Today, we focus on implications of higher tariffs, including higher interest rates for longer as inflation could get sticky, and the cost of borrowing in the US remains high, as well as rates for dollar borrowing. The International Monetary Fund analysts released a note last week on what Africa can do to reduce its debts, and we will look at that post a little closer. But first, more business stories. Late last week, we saw the UK economy unexpectedly contract again in May as business uncertainty continues to weigh on GDP. UK gross domestic product dropped 0.1% month-on-month in May. Production output was down 0.9%, and construction also fell 0.6%. Not good news for UK Finance Minister Rachel Reeves, who has been struggling to revive economic growth and bring down the budget deficit. A fresh spin on Superman this weekend grossed an estimated $122 million in domestic theatre ticket sales. It is the first theatrical debut of James Gunn and Peter Safran since they began co-heading Warner Brothers Discovery's DC Comics film and TV unit in late 2022. U.S. Office of Management and Budget Director Russell Vought vowed on Friday to press an investigation into renovations at the Federal Reserve Building, a $2.5 billion project, which he called a palace, and where costs are alleged to be running amok. Also arguing that Powell may have misled the office on the project. 9 out of 10 of the largest U.S. banks report their latest quarterly results this week. Citigroup, JP Morgan Chase, and Wells Fargo will release earnings on Tuesday, followed by Bank of America, Goldman Sachs Group, and Morgan Stanley on Wednesday. A positive outlook from the banks could offset latest tariff concerns and lift sentiment. The U.S. Consumer Price Index for June, also released on Tuesday, will be perhaps the key economic data of the week. Economists are seeing a 2.6% year-over-year increase, 0.2 of a percentage point more than what we saw in May. And on Tuesday, we get the Nigeria June CPI print. Stanbic IPTC PMI June report says inflation is expected to remain softer compared to the 2024 average. But in June, according to the PMI report, rates of inflation remained relatively sharp, but there were also further signs of cost pressures softening, and companies raised their output prices at the slowest pace in just over 2 years. Our deep dive today looks at the latest on tariffs as markets digest new announcements for the EU, Mexico, Canada, South Africa, Algeria, and we also got fresh copper sectoral tariffs, and many are hoping for a deal ahead of August 1 in what looks like a move by the United States to strengthen its hand in the final days of negotiations. The South African rand fell against the firmer dollar on Friday as tariff threats kept markets on edge. Markets dipped, but not as pronounced a plunge as we had seen on Liberation Day announcements. Markets seem to be saying we still expect the tariff rates to come down for, say, the EU, Canada, South Korea, Mexico, even perhaps South Africa, as offers are discussed to cut non-tariff barriers, for example, EU rules holding back beef imports and easing the process of expanding US LNG, defense equipment and other exports, but also as many remain in a firm parallel track vowing retaliation. All other countries who have not got letters can expect to be tariffed 15 to 20%. Also, high sectoral tariffs for copper, cars, and yet to be announced pharmaceuticals imply much higher costs of selling to the US. The hope is that citizens will switch to domestic produced goods and more investors will move their production base, but we'll have to see whether that is realized. We have to wait also to see the data on how much pass-through has to be borne by customers. The next 3 months CPI data will be quite instructive. It is almost certain that with the latest tariff announcements, the US Federal Reserve System is now less likely to cut interest rates this year as uptick in inflation spikes and more uncertainty spooks the FOMC. Analysts are also warning of underestimation of the market risk associated with replacing of the Fed chair before his tenure expires and what all that means for Fed independence. But to Africa and other heavily dollar-indebted geographies may need to actively push debt reduction strategies before they are choked by a fiscal suffocation due to heavy debt service costs. Athene Laws, Thibault Lemaire, and Nicolas Spatafora from the IMF last week in a note concluded that debt stabilization can be achieved by African economies, but it requires measures to strengthen public finances and institutions alongside pro-growth structural reforms in a sound macroeconomic environment. They added that contrary to perception, African countries like Cape Verde and Mauritius have reduced debt burdens without debt restructuring. For Mauritius, for example, a favorable domestic and external environment, solid growth, and a stable currency has led to a reduction in the debt ratio of almost 20 percentage points during the period 2003 to 2008. Indeed, stronger, more durable reductions in debt are possible where you see measures complemented by pro-growth structural reforms and helped by a supportive macroeconomic environment with low inflation and stable FX markets. Also, better tax compliance, a broader tax base, removing in efficient tax exemptions, improved transparency and accountability for tax revenues all help to build capacity for fiscal consolidation. The note also said access to concessional funding and other improved finance support will help to reduce cost of funds as countries face difficult trade-offs between short-term macroeconomic stabilization, longer-term development needs, and making reforms socially acceptable. External support can also make some of these more difficult trade-offs less daunting. The note further stressed that other measures that help include well-designed and strict fiscal rules to ensure that off-budget fiscal operations do not undermine debt reduction, pruning waste and cost of governance, and measures reducing the budget deficit involving the combination of spending cuts and revenue increases are also all going to be helpful. Budget consolidation must also be sustained over time to translate into debt consolidation. It's not a quick fix. It also helps to have a well-established and effective system of institutions, rules, and regulations that govern the country's economic, social, and political activities, typified by good governance, social stability, and cohesion, and the institutional capacity to implement reform and new policies. To get debts to fall, productivity also needs to significantly improve. Improving fiscal productivity involves not just optimizing government spending and revenue collection for better outcomes, it entails prioritizing spending on essential public services and infrastructure that directly boost growth. But reducing debt is not a magic pill, and there could be cases for higher debt in a more disciplined and efficient fiscal environment. Analysts have called for incorporatization of asset-rich government entities, resources, and commercializing and privatization also boosts productivity and creates more fiscal space for supportive infrastructure investments. Exploring alternative funding mechanisms that moves more of the fiscal burden to the private sector and frees up more funds will also help to reduce debt. This morning, in an interview, the Governor Bank of England, Andrew Bailey, said he sees the path for future rate decisions downwards ahead of the MPC's next meeting on the 7th of August. Many economists expect the rate will be cut 25 basis points from the current 4.25%. Our thoughts are with the wife and family of former Nigeria President Muhammadu Buhari, who died in London yesterday. A special Federal Executive Council session dedicated to his honor is to hold tomorrow. Still in Nigeria, the Central Bank of Nigeria has confirmed that the 301st meeting of the Monetary Policy Committee on Interest Rate Policy will be held next week on Monday, July 21 and Tuesday, July 22nd in Abuja. Asia Pacific markets closed mixed, but Bitcoin surpassed $120,000, hitting a record high as investors digested news of 30% US tariffs on the European Union and Mexico imposed over the weekend. German Chancellor Friedrich Merz said the latest US tariff threat would hurt exporters if a negotiated solution can't be found in coming weeks. Antonio Tajani, Italy's foreign minister, reiterated that the EU had prepared a list of tariffs on US goods if the two sides fail to reach a trade deal. European markets this morning opened lower. China's exports were up 5.8% in June from a year earlier, better than estimates of a 5% rise, while imports also climbed 1.1% from a year earlier. Exports growth beat expectations as a temporary reprieve from US tariffs helped slow the decline in goods sent to America. Singapore's economy grew at 4.3% year over year in the second quarter, accelerating from 4.1% in Q1 and also beating expectations. Well, that's it on this episode of Global Business Insights. This is Bode Oshosami. Thanks for subscribing. Thanks for watching, and bye-bye.